Well, investors are betting that the bull market is just getting started. CBOE Global Markets data shows investors piling into options contracts for the Nasdaq Composite and the S&P 500 index. Fear of missing out on the AI hype also means that the bulk of trades are piling into chips and other big tech stocks, leaving a wide breadth between the market winners and losers. Well, could that gap close in the coming weeks? If so, which sectors should you be betting on? Joining us now is Adam Turnquist, LPL Financial Chief Technical Strategist. Good to see you, Adam. So break this down for us, because we could be, as you said, perhaps getting a breather, or perhaps this bull run might be due for a breather. What would that look like?
Yeah, I think it's just a case of a little bit too much too fast for this bull market. We've had a great run off the October 2022 lows, officially acknowledge those as the bear market lows. I think there's overwhelming technical evidence that supports we're in a bull market, and not just that 20% qualifier off those lows. We're in an uptrend. The moving averages confirm that. Momentum confirms that. But speaking of momentum, we're looking a little bit overbought here in June, and that's really where our call is that we're going to see a breather here for this relatively new bull market. Part of that call is based on the technology sector. That's really where we're seeing overbought conditions broad-based. And if you think about technology, that's really been the main driver of this year's rally. If you strip out the tech sector, the S&P 500 is up about 5% year to date. So there's some pretty big shoes to fill for other sectors if we get a pause in technology. If you look at the technical setup for the technology sector, it's well extended above its moving average, actually hit a 13% premium above its 50-day moving average. Now, that's a 2 standard deviation move. We like to look at that as kind of a rubber band. As it gets stretched too far, you often get at least a pause or a potential pullback. So we think that could spill over into the S&P 500. Now, to end on a good note, the positive sign when you get a mean reversion in a bull market, you usually come back to the longer term uptrend, the S&P 500. We think worst case scenario, that could be right around the 200-day moving average.
So we're going to break some of that down, because as you mentioned there, if we do have this breather, then which are some of the sectors you think are really primed to try and at least fill some of those shoes if tech it does start to pull back a little bit?
Yeah, so we really like the industrial sector. Technically, it looks constructive, and thematically, when you look technically, we'll start there. It recently bounced off its 200-day moving average, broke out of this consolidation range that it's been stuck in for most of the year. So it hasn't really participated in this rally except for the last few weeks. So we're seeing the sector broaden out, get back toward record high territory, and also relative strength. When you compare it to the S&P 500, that's actually reasserting itself into an uptrend. And again, breadth is expanding there. We're seeing a lot of new 52-week highs within that industrial sector. Big part of that, I think, is going to be this reshoring theme that we continue to hear about, especially among CEOs. It was actually one of the most mentioned, the reshoring tagline was one of the most mentioned things in the Q1 earnings call, even more than AI, according to some reports. So I think that fund flows will continue to move into the industrial sector. From a valuation standpoint, it looks relatively cheap relative to its own history. So we continue to like that on the as a potential area where capital could flow out of tech and into the industrial sector.
So let's talk inflection points here, because you noted the cumulative S&P 500 advanced decline. You're saying that that's at an important inflection point. Break that down for us and what historically has tended to happen when we see this.
Yeah, so the advanced decline line, or the cumulative advanced decline line for the S&P 500, simply just measures the number of advancing stocks versus the number of declining stocks. When it's moving higher, that means there's more advancers than decliners. And we like to use this as a measure of market breadth to confirm or deviate from an actual breakout point. And that advanced decline line is basically stalled right at the August highs. So we're waiting for confirmation there to see if it breaks out. That would give additional validation to the S&P 500's breakout above 4,300. We have not seen that inflection point yet, so we're potentially seeing a divergence here, with the S&P 500 moving higher and that advanced decline line failing to confirm that recent breakout.
And of course, we have a number of factors at play. You have a lot of people pouring in because of this AI fervor, but you also have the Fed, at least in pause or skip mode, still expecting 2 more rate hikes by the end of the year. So then when you factor in the fact that markets are essentially either ignoring it or looking past some of those warnings from the Fed, how do you position your portfolio?
Yeah, so we're actually overweight toward fixed income right now and an up in quality approach. We think it's time for investors to lock in some of these high yields, especially how inverted the yield curve is right now. You can get money market funds that are 5%, but there's reinvestment risk there. So we're actually recommending shorter duration, high quality corporates, locking in some of those rates right now for our clients.
I appreciate you taking the time this morning. Adam Turnquist there, LPL Financial Chief Technical Strategist. Thank you for joining me this morning.
Thank you.